All right, let me get my screen going here. We will do questions afterwards. All right. Okay, so we'll get this show on the road. My name is Catherine Barnett. I'm with LoanFIT. I've been in mortgages since 2002, and I've been a mortgage broker since 2018. Last night, one of my most favorite investors, which is UWM, launched they had their big annual conference, and in that conference that they announced that they are launching their zero money down program. Now, mind you, they have had a 1% down, but it was kind of gimmicky. Not a lot of people fit into it and still had to bring a good chunk of money down. So now they have a true zero down conventional loan, which there's not many. In certain states like Colorado, you have CHAFA, and CHAFA is great in some aspects, but their mortgage insurance is usually higher, as well as their interest rate and their closing costs. So knowing that we're going to be able to squeeze some people into a low rate has me super excited. So this little class is called No Money, No Problem. And I appreciate you guys joining me today. So how this works right now is that this is going to be a first lien of 97%. And then you're going to be able to get a 3% kind of silent second. So it's a true silent second where they don't have to make any interest payments. It doesn't collect any interest. It just hangs out as a second mortgage. With that, if they were to refinance or sell, that's when that second mortgage is going to get paid off. So going forward, guys, when you're getting your listings, make sure that you're doing a full title search and exposing any possible liens that could be on the property, because this is going to be one that they're going to get, and then they're probably going to forget that they have. Second lien will go up to 3% or 15,000, the lower of the two. So we're really going to be capped on a purchase price range, but you'll see we're going to be capped in some income restrictions. So it's gonna work itself out to where 15,000 is probably going to be close to the highest we can go anyways. If they are doing the no money down program, for instance, and it exceeds $15,000 for that 3%, they can bring the difference to closing. So, a couple $1,000s, etc. Again, second lien has no monthly payment, no interest, and it's due when the loan is paid off. Okay, so here is the kicker. There's two different programs. There is the 80% AMI. I'm going to go over what AMI is, but AMI is average median income. And so 80% of that or lower, we're going to fit into the Home Possible. Home Possible is already a Freddie Mac loan, but it's offered with 3% financing. What I love about Home Possible, it's a brother to Home Ready. What I love about those two programs is that if you fit into those programs, all loan level price adjustments are eliminated. For instance, a loan level price adjustment is when someone purchases a condo, and that condo has what they call a pricing hit of 0.75%. So every $100,000 is going to cost $750 to that rate and to the price of the loan. So if they fit into a Home Possible or Home Ready, all of these loan level price adjustments are eliminated. So it really makes this program super competitive. We could go down to a minimum credit score of 620. We're going to use the middle of the two credit scores if there's co-borrower or borrowers on there. Loan to value, it's 3% down. We could go down to 95% down. And the way that would happen is that we would do a 95% loan, they would bring 2%, we would help them with the 3%, or a 97% loan and we would help with the 3%. Where that's going to help is in mortgage insurance. So we're going to want to strategize. If we do have borrowers that have 2% down, then let's look at that. This is available to all home buyers. Does not have to be a first-time home buyer, but they do have to fall in the income limits. And again, I'll go over that more because there's exciting news coming down the pipe with that as well. Max assistance is going to be $15,000, must meet Freddie Mac guidelines. Freddie Mac is an underutilized entity in our lending world. Most people go to Fannie Mae first, but Freddie Mac has some leniency, one of which is to deal with student loans, has some leniency that Fannie Mae does not. So just keep that in mind. We're going to move into kind of a less restrictive program, and so I'm super excited about that. The other program is going to be our no AMI limit. It's called the Home One. This program also already exists with 3% down. They do have a tighter credit score requirement. You have to have a 700 credit score. You can do the same thing as the other one, where you could do a 3% down for a 97% loan, or you could put an extra 2% down and do a 95% down. The one kicker on this one is one borrower must be a first-time home buyer. So the only way they'll qualify into this one is if one buyer has not owned a home in the past 3 years, is a first-time homeowner. So again, max assistant, if it's $15,000, they have to meet. It's Freddie Mac guidelines is what Home One guidelines are. So couple things that will have to do with this program, one of which is the home buyer will have to take a first-time home buyer class when they are a first-time home buyer. So we'll help them with that. Those classes vary and they range about $90. And I believe only one of them has to take it if we follow the regular Freddie Mac Home Possible guidelines. They do allow a non-occupied, I meant to put non in there, sorry, delete it. It's a non-occupied co-signers are allowed on Home Possible only. This is a rare exception because they still have to fall under the AMI. It's not going to be often that this happens, but a non-occupied co-borrower is allowed. And that's only on Home Possible. So it's on the first one under the AMI, not the second one. No manufactured housing right now. This may change, but right now it's no manufactured housing. Manufactured is allowed on your Home Possible and your Home Ready programs, just not on the down payment assistance program. Temporary buy down is also allowed, but getting into the gimmicky world of temporary buy downs, it has to make sense, and you're restricted to seller concessions of 3%. All right, so it only makes sense to do a temporary buy down if the seller is paying for all of the closing costs and all of the temporary buy down, and that is going to exceed 3%. If the seller is not paying all of the closing costs, my suggestion is have them pay all of the closing costs, and then the buyer can just keep the money that they were going to pay in their closing costs and supplement their own payments. So that's where the whole temporary buy down thing is a little bit gimmicky. Okay, AMI. What is AMI? This is the area median income. It's used to calculate income limits on program eligibility, in some cases affordable rents for a host of federal and local programs, including the largest affordable housing programs. This number, and it's like, you know, this class is just right ahead of the game, where the AMI is changing over the weekend. So what I have right now for you guys are just AMI examples of 2023, but they have not released 2024 yet. I did pull these this morning. They haven't been released, but it's coming down the pipe. We'll start with Larimer County. 80% of that median income is going to be $94,960. So, and keep in mind, this is qualifying income, not household income. They can make $200,000 a year between the family, but if we're only using, you know, $90,000 to qualify, then we can slip them into this program because it's qualifying income, not household income. Maricopa is sitting at $79,200. Baldwin, I do a lot in Gulf Shores because I have one of my favorite agents that moved from Denver to Gulf Shores. So now I'm doing a lot of loans in Gulf Shores, and their area median income is $74,400. We do lend in 44 different states. So if you have a property that you're trying to market, or you have a buyer that you're working with in any other state, I'm happy to run what the AMI is on that. And I'll probably post what new AMI limits are as soon as they're released, hopefully by Monday is my hope. Wow, this is huge. So I wanted to give a comparison of an FHA with 3.5% down, a conventional with 3% down, and then the last one being the 30-year conventional with 0 down. The biggest thing that this program is just going to come in handy for, guys, are the folks who have the income or the folks who have everything else to get a loan except for the down payment. If they have a down payment, there may be better alternatives. As you can tell, if we look at the total estimated payment here for FHA, it's $3,437. And if we look at the 0 down, it's $3,609. And that's because the mortgage insurance on conventional is higher, as well as the interest rate. The interest rate's almost 0.5% higher. So FHA ends up winning against conventional with 3% down. It ends up winning actually against conventional with 5% down and sometimes 10% down, depending on the credit score. And it's absolutely going to be conventional with no money down. But as you can tell, the cash to close for FHA is going to be $24,000. The cash to close for conventional is $10,000. And all of that can come from the seller because it's just closing costs. So it's a super affordable program. It is great for those properties that won't accept FHA. It is great for those borrowers. I have a borrower right now where they are buying a home from an ex-husband, totally weird situation, but buying a home from an ex-husband, and he is selling it to them for like $100,000 cheap, but he refuses to do a gift of equity. So they don't want to do the FHA and have to pay this huge upfront funding fee of $7,500, because that's the other thing to pay attention to with FHA. You have a huge upfront mortgage insurance that's rolled on top of the loan. So that upfront mortgage insurance is $7,599 rolled right on top of the loan. So now they owe that on top of everything. So if you have somebody who is probably going to be refinancing here soon, who is in their circumstance where they have a lot of equity and they're going to refinance after 6 months and pay off that second mortgage, lower the interest rate, and now they've got 20% in equity because they were getting a steal of a deal. So we're going to want to analyze it. And I always say sometimes when we come out with new programs, they could be a little gimmicky. We can sell gimmicky. We just have to make sure we're evaluating what is best for the client and making sure that we meet their goals. So in this case, if they're struggling to come with cash money down, then the 30-year 0 down is absolutely a great avenue. You're really kind of paying for it in the payment, but you don't have to bring the down. And then the other one, this is if they are over the AMI. So if they're over the AMI, but one of the borrowers is a first-time home buyer, again, you have to have a 700 credit score. This one's a bit more ugly. So I would highly encourage trying to move into FHA if they can swing it. But if not, the 0 down, although the rate is high, we're looking at a 7.99% interest rate. All of this cash to close up until about 13,500 can be paid by the seller. So if the seller pays 13,500 of this, they're only going to be coming to the table with about $2,000. So still not bad for those folks who are over the income limits and don't have any down payment saved. And then again, I think a lot of these interest rates are temporary. Rates are already coming down. So if you have any buyers who have closed in October, let's say September, October, November of 2023, they are more than likely eligible for a refinance. If they have closed in the past month, they might be eligible for a refinance. So, you know, it's where rates are slowly starting to come down. We go up a lot faster than we come down, and the Fed still have not lowered the interest rate. So until then, our rates are slowly going to come down. And as Feds lower the interest rate, we might see a good dip, and then we're going to slowly come down again. So at least they're improving, because April 10th was a bloodbath in our market. Absolute bloodbath. So let's talk about how we market these. Let's find some buyers. First of all, if you have old listing or old leads, Zillow leads, people you've spoken to in the past 2 years, is like, I'm just waiting to save up money. start reaching out to them and say, hey, we've got a great 100% program out there. Let's reevaluate numbers. If you have a listing, you can easily say this listing qualifies for 100% financing, just like we would do with USDA if it was in a USDA area, because the property does qualify for 100% financing. Now we just got to get the buyer to qualify for 100% financing. We will want to look in that range. I would say about I think it's 500,000 is going to be the max limit for 100% financing. I'll fine tune that and let you guys know when I send an email. Nick, I don't know if I have your updated email, so if you could pop it in the chat, I'll make sure that I have it. Everyone else, I do believe I have. Just to go, any listing below this number, you can mark it 100% financing. Right now, we do have more inventory than we've had in a long time. It's still absolutely a weird market. In some cases, we're seeing homes go under contract with multiple offers within the first day or two above asking price. And then we're seeing homes sit for 2 months, 3 months, 4 months that are selling a lot lower than what they're asking for. So it's still a weird market. Buyers still have room for negotiation. So they could truly come in with zero down if they get a seller willing to pay their closing costs. So this could be a true zero out-of-pocket loan if they have a seller willing to bring closing costs. Rates are lower. Reach out to old leads. We can offer a fast close. So one thing that is better than some of your down payment assistance programs out there, those loans take time. This loan will not take time. This loan, we can easily close within 14 to 21 days. I prefer 21 days so we're not all crazy. But we can quickly close this loan. It doesn't require any second underwrite that a lot of down payment assistance programs do. And they're just going to run off the first, and then that second for 3% is just going to hang out in the back. And then that's it. I told you guys it would be a fast class. I didn't want to take up too much of your time. And I am ready to handle any clients you dig up. I challenge you to go through some old stuff. We're doing it. I've challenged my staff. Like, let's go through some of these clients that we're saving up for a down payment. And let's see if we can get them qualified into homes. And if I could be of a guidance, let me know. I'll shoot this presentation over to you guys. And yeah, I'm open for any questions. So if you guys have questions, fire them away. Yeah, Shirley, I'll send you Weld County. Yep. I can also send you guys the link that you can pull the county up for us. So you can pull, or for you. So I could just give you the link to where you can search and you can pull the county up yourself. Because sometimes it's not just county specific. Sometimes it's area specific. And you'll find that in like metro areas, Phoenix, Denver, where you'll see a variance. And I don't know what it's going to look like when the new AMI is released, but you may see a variance from city to city because of the income limits, like Boulder, right? Boulder is going to have a higher income limit than, say, Fort Collins, because Boulder is just a higher end area. So you'll want to run it per property. I can give that to you guys, not a problem. And yeah, Michelle, I love having more options for clients. I'm excited about it. I am always hesitant, and I am one of those that I like to just make sure to look out for what's the best interest for the client. So we're going to offer it, but we're also going to weigh out some pros and cons and go, okay, it's a better loan if you can do this. But if you absolutely can't do this, then this is a great loan. So it's not a one fits all type situation, but it's a little bit of ammunition in our pocket, and it gets people excited. I love programs that get people excited. So to hear that there's zero down and it gets people excited that it's a conventional loan, it's at a great interest rate. They're not, unless you're above the AMI. If you're below the AMI, I mean, we're talking at below market rates right now, because if you were to do a conventional loan with 20% down, your rate is going to sit in the low sevens, high sixes. And so right now we're in the high sixes. So we're super competitive on this program rather than some of the other loans that are out there that give you the 3%, but they're going to mark that rate kind of like the above the AMI option. They're going to mark that rate up to pay for it. So we are here to help. We'll be around over the weekend. So if you guys have questions or you know anybody else who needs this information, just let us know. Any other questions before I let you guys go? Let me see here. Do you have any kind of spreadsheet or flyer that shows loan products as a new agent? Yeah, I do have a flyer that kind of shows all of our loan products. The problem is, Nick, is that it's a rabbit hole because then you have to figure out what those loan products are. So I'm one of those, bring the scenario to me and run it by me and we'll go, okay, it'll classify for this one, it'll classify for that one, it won't work for this one, that type of situation. Because if I just throw products at you, you're gonna go, well, what is that? And then that one product is gonna have this whole mountain of information below as to whether or not they qualify. So let us be your filter in that. Cool. All right. Well, I will let you guys get back at your Friday. You guys have an amazing weekend. And if you need something from me, just give me a holler. Okay, bye.